been the former E-Trade CEO, now CEO at Lefteris Acquisition Corp. Carl Rosner, thank you so much for being here. I do want to start with this question surrounding the business model of brokerage firms. Kate mentioned this idea of payment for order flow, which has enabled brokerage firms like Robinhood and others to allow for commission-free trading. It essentially require or has certain market makers paying them for their orders, and then those market makers are the ones who execute the trades off of exchanges. Do you think that this whole attention to PFOF, as it's colloquially known, is going to create some sort of reckoning for a business model that few people really paid much attention to before this, or do you think this is something that's actually providing a benefit to investors since they're able to trade effectively for free?
So first and foremost, thanks for having me back on. When I look at payment for order flow and the way that was structured, I think there are definitely a lot of benefits that come through from it to the investor, particularly the retail investor, in terms of speed of execution, the amount that they get on price improvement, the manner in which their trades are matched. Right, they're getting some of the best execution that has ever been delivered in the space. The speed with which trades are now executed, you press a button, it's done, it's in your account, and in all likelihood, you've gotten some semblance of price improvement. So, but I think there's a broader question in terms of the individuals who are testifying today, who's going to be there as witnesses for the hearing, and sort of where Chairwoman Waters is taking this. There are a number of different pieces, right? These are some very weighty topics in each of their own right. So payment for order flow goes to the entirety of market structure. You can't just flip a switch, turn off payment for order flow without damaging a whole bunch of other pieces within a system that works very well right now. So, I honestly have a lot to say about payment for order flow, because you have to run it right? It is permitted by the SEC, and it's something that most of, if not all of, the sort of retail brokerages have participated in at one point or another. And you have to do it right. You have to protect your customer. The thing that most people don't get or don't understand when they start talking about all these payments and other pieces, when you do the calculations correctly and you weigh those market centers that you're going to route your trades to, right, one against the other, you're not supposed to look at price being paid. Right? You need to look at execution quality alone, and you only look at the pricing on the other side of it, or the mill rate that might get paid, if there's a tie or they're otherwise sort of an even playing field. So as long as you're doing it right, there shouldn't be any disadvantageous movement toward a retail investor. Yeah,
I think in Tenev's testimony, he said that their customers have received about a $1 billion price benefit from using this method. But, I'm curious, without necessarily turning that spigot off, turning payment for order flow off entirely, are there certain improvements that you think can be made that help maybe address some of the conflicts of interest questions or address some of the transparency questions that lawmakers and others have raised about this method?
So again, on payment for order flow, if you're doing it right in terms of order routing, there are reports that each broker is responsible for publishing in terms of what they did with order flow and order routing, and those are pretty well out there. And there's more, I think, more push for transparency, which is always a good thing in this industry. And I think that could really help the retail investor. But I think the focus here just seems to be that there's some kind of a massive conflict, that these brokerages are really going out and making money. If you're doing it right and you're following the letter of the law that's there, it should be a very easy view to see which market center is providing you the best possible execution quality with the technology that they have. And they can all crank that, that speed of execution and where they execute their trades. They can crank that up based on the demands of the brokerage when you pit one against the other, right? It's a highly competitive space.
Carl, congressional hearings often descend into theater, particularly on the House side. But I don't know, the tone that we're hearing has been a very hearty policy discussion. I wonder if you have higher hopes for today's hearing relative to some of the ones of the past.
So without being negative, because I sort of try to be positive all the time, I don't think a lot will come out of the hearing today, right? I don't think you're going to see a lot coming out of this congressional hearing. I think you're going to see a lot of mudslinging, a lot of grandstanding. I'm hopeful that the witnesses all stick to their prepared remarks and their areas of expertise, and they don't go off astray or afield because of some of the questions that will be thrown at them. But I do think there are real issues here, Carl, that need to be addressed, and each one of them should be broken out separately And I am hopeful that, the Secretary Yellen, if and when Gary Gensler is confirmed, and you start to get some pragmatic individuals with real experience around the table who can dissect each one of these issues and start to make some changes that will make sense, the worst possible thing will be knee-jerk reactions coming out of today's hearings.
Yeah, Carl, it's David. Yeah, that's always a concern. I'm curious, though, if there was one question that you could ask of one person joining the hearing today, is there one? And who would it be to, and what would it be?
So my question on this whole piece, having sort of been at the helm of one of these firms in the past, the decision to stop trading in an individual name is one of the harshest things that you can do. And I don't mean that in terms of the wrong thing. I just mean you need to have facts around you that say, we need to stop this right now, right? That question I would want to see answered. Why was that decision made? What were the facts that were surrounding it? And what actually happened? Be transparent about it. Let us all know. And if it was something that you did because it was going to protect the firm, come out and say it.
Shepard Smith here. Thanks for watching CNBC on YouTube.